Welcome back, everyone. For the second time this year, there is a stock that I've been watching for a while, but I've decided to buy. And so today I'm going to be sharing what that is and why I'm buying it. So very briefly, my history here. This is a stock I've been watching for about 2.5 years, maybe slightly more, maybe slightly less. I'm not exactly sure. I was close a few times to buying it, but I hadn't yet. And I kept watching it and it kept kind of nagging at me. The closest, recently, last March, so I guess a year ago, I had a really close look, decided to go with some other things that had higher beta. And this is kind of underperformed, but it keeps bugging me because it's I really like it, but I don't see a catalyst. So the company is Dream Unlimited Corporation. Their market cap's about $1 billion Canadian. Price to earnings, I'll get to why this doesn't really matter later, but it doesn't in the short term. Dividends, about 1.25%, so not that high. And the price to book, 0.73 approximately. So cheap, but not crazy cheap. But I'll get to why I like it, because there's a lot to like here. So, in the very simple terms, this is a real estate development company that has grown their equity per share at 18% compounded over the last 6 years. Now, I know 18% doesn't sound like a hyper growth stock, but consider since Buffett's been at Berkshire, he's grown the book value there at an average of 19.1% per year over the whole time. So the power of compounding, and I'll get more to this later, is very much should be on display here. And remember, this is something that trades at a relevant discount to their book value now. One of the things that I really like about this company is that the CEO, who by the way has had a well above average track record of success and building this company, really. He owns 42% of the company and he has added over time. So the interests there are aligned with doing what will create the most shareholder value rather than temporary short-termism. So sometimes in the market there are reasons why things are cheap. And I think that in this case it's not so much a good reason as a market reason. By that I mean, in this company, when you're trying to value it, there's a lot of different segments that you have to look at. And it's quite possible that some or many people will look at the different segments and say, okay, this is fine. I'm not really bullish, so should take a discount. But when you look at this one and you add all the pieces together, and you can debate individual pieces, and I'll get to a little bit of that in a second. In terms of some of the pieces, you could argue maybe should have a discount for whatever reason, but I think overall there's a number of parts here that probably could be easily valued above where they are in this book calculation. And so I think that the market just doesn't like looking at this as a sum of the parts, and so it may think, market thinks, that it should deserve a discount. And that's why I look at this as a book growth story, because if you zoom way out, not pick at the little pieces, you look at the whole picture of how the company is growing, it's a good growth story, and it's really cheap now. And the other thing is that I think the market might not like is the earnings are very lumpy. It's not, this quarter you make $1, the next quarter you make $1.10. It's not at all like that. It's some years or some quarters you might make, $3 a share, and other quarters you might lose 10 cents a share. So it's very lumpy, and in general, it's a good business, but doesn't may not mesh well with the markets at all times because you look at value screener, you look at this, that, and the other thing, and it doesn't really look like something that's linear trajectory in terms of earnings growth. Now, I'm sure there's also some people that will argue that, yeah, but the book is bull. As a whole, I really don't think so. I think if you look at each of the assets across all across the board, yeah, I could be skeptical or bearish and say some may deserve a bit of a write down. But overall, I honestly think that, and again, don't take my word for anything I say here. I think that across the board, the assets are actually understated on the book, and I would argue that the book should actually be relatively significantly higher than where it actually is, because a number of the assets have been on the books for a long time and should probably be higher. I'm sure the skeptics will say that's unlikely, and look, I'm not giving you any answers here. I would invite anyone who's interested in the company to look at the individual parts and see what they think. But I don't also, I don't necessarily like using some of the parts type of argument on non-producing assets, but if you were to look at what the book actually says versus what you think some of the assets might actually be marketable for, I think that the closer number is 40 than 30 Canadian per share for what the asset value should be of the company. And again, going back to the very simplistic view that I started this with, I think that the way that the market is going to realize either this or how the market will reflect the true value of the company is the growth. If they keep executing on the growth, then one way or another, the value of the assets is going to increase, and then the debate will be from a different cost base. But the fact is, at this point, the company is trading at between a noticeable and a significant discount to book. So the question is not in the market, the question isn't what type of premium does this thing deserve? It's how big a discount does it deserve? And honestly, taking a few steps back, looking at the company, I would say probably deserves a premium. But that's not where we are. And so we are at a discount to book. And in this environment, it makes a lot of sense for them to spend money buying back shares, because if you can get it at a bigger discount than how you would spend the capital, well, you're growing book value per share without really too much effort. And so in that respect, let's say the prices stay lower, you know, that's fine because that just makes the NCIB more effective. Now, the NCIB has its limits, otherwise the growth would accelerate beyond the 18%. And this chart, I really think drives home the point of look in the blue. That is the book value per share over time of the company. It's been growing, it's been growing, it's been growing. In the black, that is the price to book of the company. So as the company has gotten bigger, gotten more relevant, you could even argue, the market has cared less and less about the book. So when it was book of $10, the market was valuing it as a 3 times book. But now we are where the book is and the market cares less. So in that regard, this company has rarely, if ever, been cheaper on a price to book basis than it has been today, because in the past, the market seemed to have recognized this as a good company. Now it doesn't. Now, I feel like this is the point where I should mention that this isn't a company that has grown to be too big and doesn't have any growth left and has used up all its assets. Not at all. This is a $1 billion Canadian company that has many initiatives still in the pipeline, many just starting up. It has a lot of land. It has multiple projects under construction, multiple regions, And they've just started up a new asset management business that has a lot of potential to grow at to a significant scale if they can, well, if it's successful. Now, I just want to take a little bit of time to have a look at where I think this company should be trading to be priced more fairly versus where it is now. So I'm going to look at valuation and targets and what that would mean. So the two main cases I use when looking at what the company should be worth, one I'll call a rational bull case, the other I'll call a bit more aggressive bull case. Neither of them I think are crazy, because in my rational bull case, I kind of assume that there's going to be some lingering impacts and that the discount to NAV will take, or discount to book will take a long time to close. I assume it kind of closes over 10 years gradually, which is very generous to the bears, I would say. Of course, there can be write-downs and all sorts of stuff like that, but that's not what's assumed in this case. I do assume a 15% growth rate instead of 18%, which has been the track record of 18, and I don't think there's too much reason to fight that at this point. And then you have, on the other hand, the aggressive bull case seen on the right, and that basically the difference there is I don't really think it's that aggressive, but it assumes that NAV is the target in the near term and that growth continues at the current pace. And I think that in either of these cases, there's a well above market returns to be found here for limited permanent capital loss risk. So yes, the conservative assumes 15% growth, discount disappears gradually over 10 years. Actually, the aggressive, I should clarify, 18% compounded, and also assumes that the stock should trade at 13.5% above book, which would mean that your expected returns would be down to 15% because, you know, if they're growing at 18%, then I would argue that they should probably trade above book. So that was the other part of the assumption on the aggressive model. So for me, the target with this stock is a long-term hold, and that's how I think about it. Will I? Well, it will depend on the price, but when I'm targeting a long-term hold, I'm targeting a value of the company in the future, and this is the real benefit of a company like this in terms of you start below where the value should be, again, opinion, but you can see how over time the increase in the value at a rate that it has historically increased at can lead to the small moves in the short term kind of fading over the long term if they are able to continue. So this is what the compounded at 18% made level, and this company, it's not always level because of how it works, but over time this is the thinking. Now I'm sure many of you will have heard of GARP and some of you will not have. A friend of mine thought I made that up at one point. GARP being growth at a reasonable price, but I don't think that's what this is. I think this is growth at a good price. It starts being growth at a reasonable price when this thing's trading probably about 15% above book. But right now, it's trading below book. Maybe there's some reasons arguable, but I think that this is growth at a good price if thought about on a longer term time horizon. When evaluating an investment, the thing I often look at or ask myself is what takes it 2x or more? Like, so what doubles it from here? And in this case, it starts with the fact that I believe it's undervalued today. So closing that valuation gap gets you, let's call it a third to a half of the way to double. Then you add share buyback, 5% per year. So, and that accelerates some of the value creation. Then you look at the growth, and this is if you look at what is in the development pipeline, the gross leasable area goes from 6.9 million square feet to 11.7 million. And that is a significant bit of growth that is currently just in the process of being completed. You add to that the asset management segment, and who knows what will be in the pipeline in a few years, and maybe the company will start looking forward. But again, if it doesn't, it gets cheaper and cheaper and cheaper. And at some point, I believe that the market will discover that, oh, there's something here. And I think that also at some point, market will figure out that it's something good here and value it like that. But I'm fine waiting. So what's the plan here? Well, I have initiated a rather large starter position, and I plan on adding more either if it goes lower or over time. As potentially more high risk money gets taken off the table, might move it into medium to low risk, which is this type of thing. Not saying that this has no risk, but compared to the rest of my portfolio, this is low risk. It's a great business. I plan at this point to hold for a long time, multiple years, forever. I don't know what that means. Will really depend on price. But I think this one will eventually at least double, and I don't think there's too significant a risk of permanent capital loss in the meantime. That's not to say that the share price won't go down. It's to say that I don't think it's going to end in flames. Anyway, that's basically all I want to say in today's brief outline of this new investment. Remember, nothing I say is investment advice. This position will, however, as of today, as of now, go in the tracker portfolio, and I will keep that updated. So with that, until next time, I wish everyone the best. Have a great day.